Ladies and gentlemen, we are going to experience a bear market rally or a bear market bounce, whatever you want to call it, in my personal opinion. And we actually did hit bear market territory on the S&P 500 intraday on Friday, and then seen a wild reversal in the last hour of trading. The Nasdaq reversed about 2.4% of losses. The S&P reversed about 1.7% of losses to actually close slightly positive on the day. Now, I want to go over exactly why this is, what the data is for the upcoming week, and potentially what could happen in my personal opinion. It's not to say the lows are in for the year. It is to say there is a very tradable bounce here, and kind of to put everyone's expectations along the same lines, because a lot of people I've been hearing, and I know you've been hearing, we're going into a Great Depression. The stock market is not going to make new all-time highs for 5 or 10 years, which may or may not be true, but I want to acknowledge a simple fact before we even get into any of the other facts here in this video, that the stock market, especially in the Nasdaq, has fallen more now than it did during the crash of 2020. From peak to trough, we are still currently down about 30%. Intraday Friday, we were down about 32% on the Nasdaq. If we do peak to trough during the crash of 2020, we were only ever down about 29%. I think at the very low, we were down about 30% comparatively to where we are currently at. So to put that into context, you have already seen an incredible amount of pain and carnage just bleeding out for the past 6 months. We are well overdue for a bear market rally. So we are going to dive into all of this key information. If you guys are new to the channel, my name is Michael Tyler. Consider liking the video, subscribing to the channel, and sticking around a while. Hopefully we can learn some financial education in this video. Hopefully something you did not know already. So let's get straight into it, guys. Without any further ado, like I said, it's been a very rough 6 months. So if you are still here, you got to just give it up for yourself, because a lot of people have quit and given up a long time ago. They've got margin calls, they got out of the markets, right? And if you're watching this video, you're obviously not one of them, so you're already doing very well. And I think this is a generational buying opportunity, because usually you see market crashes that are like V-shaped recoveries, right? 2020, you had like a month or two to buy the dip. That was it. And you made a lot of money coming out of it. I think on everything I bought, I was up 100% in literally like 2 to 4 weeks, which that happens when the Fed is your friend, right? You get those 2018 crashes as well, and then the markets come back when the Fed is your friend. Fed is not your friend, so that's why you're not seeing a sharp V-shaped recovery. It's just a slow bleed to the downside. Now, at this point, you have done a lot of damage, and the markets are pricing in that we are probably in a recession right now. They're pricing in the Fed is going to raise rates to astronomically high amounts. They're pricing in that the war in Russia and Ukraine is going to last forever, that inflation is not going to go down, that oil prices are going to go to $8 to $10 a barrel for a gallon of gas. They're also pricing in that the Chinese economy is going into recession. They're pricing in that China is not going to open up for at least the next couple of months, which, if any one of those things turn out to be not true, if we don't go into recession as fast as the markets project, if Russia does not continue this war for years, if oil does not keep going up, which oil and Russia, Ukraine, that situation over there, those are pretty closely tied to each other. So you could kind of group that into one category. Or if China does ultimately open up here in the next coming weeks and coming months, there will be a substantial reason for a bounce. But I will tell you guys right now, we have not seen any positive news in a very, very long time. So there's not a huge reason to actually go out and buy stocks. That's why a lot of people are in cash right now. That's why a lot of people are kind of stepping away from the markets, even though this is the generational buying opportunity. Once we come out of this on the backside, I don't know if it'll be 6 months. I don't know if it'll be 2 years from now, but I would imagine it wouldn't last longer than 2 years. Then you're going to be in a much better spot if you do take this opportunity to load up on quality companies that you want to own for the long term. You really have to have a long-term outlook on this market. But why am I sitting here and talking about a bear market bounce or a bear market rally? Well, There's something interesting that happens when the stock market, specifically the S&P 500, hits 20% down peak to trough, like we did on Friday. If there is bad news on that day, then you tend to flush under and you tend to substantially go under 20%. Like when the COVID pandemic happened, we hit 20%, we went 10% lower than that, down about 30% from peak to trough during the COVID crash, right? Because there was a reason to crash. They were shutting down the economy, so on and so forth. Right now, where we currently sit, the markets hit 20% bear market, and there was really no news to go off of for the day. So it changes the market's conception and dynamic about what is going on. People start to take a step back and say, hey, should we really continue to be selling these stocks when we just hit a 20% bear market and we have a lot of bad news that is priced in, when nothing in all reality has actually came to fruition, right? Russia, Ukraine, that's been going on for 3 months now, 2-3 months now. You got the China lockdowns, which started about a month ago. You got the fears of a recession, but not really any earnings that are anticipating a recession. You have the Fed saying they're going to do this and that, but in all reality, they have raised 75 basis points, right? Even though these things might be coming down the line, we have gotten way ahead of the Fed. We've gotten way ahead of the bad news as of right now. And if the markets, like they did on Friday, take a step back and realize that, hey, we might be right on what we are pricing in, but maybe we're pricing in too much too fast. That's where you start to get the change of dynamic. You hit 20% down and people start to kind of change their tone a bit. And I think that's why you've seen the reversal on Friday. But don't just listen to me. Listen to what Mark Newton, head of technical strategy at Fundstrat, has to say about this bear market rally. He says, stocks are ready for a bounce higher after S&P 500 rallies out of bear market. The stock market came awfully close to finishing in a bear market, at least 20% off its peak in early January. Many investors would like to see it get there so Wall Street could put that aside and start the work of moving higher. Mark Newton, head of technical strategy at Fundstrat, doesn't necessarily think we'll get that so-called capitulation, the time when investors sell in mass because they've given up on recouping their losses. In fact, Newton thinks that the stock market's late day reversal on Friday provides hope that a minor bounce is underway. Quote, while I dislike making big counter trend calls within downtrends, markets likely have exhausted themselves near term to the downside and could rally into late May, Newton said in a research note. And there's going to be a lot of reasons this week to potentially rally or potentially become a lot more fearful very, very quickly. This upcoming week, as far as data, is going to be a very, very important one. Let's go ahead and take a look at the economic calendar as to what is going to be happening this upcoming week. So on Monday, you don't really have anything too important. You have some Fed auctions for treasury bonds, stuff like that. But Monday is going to be a pretty slow day, and I think you're going to see a lot of positioning for these data points that come out later in the week. Now on Tuesday, what do you get? You get some news out of Great Britain, nothing too crazy. You do have new home sales, which comes out at 9 a.m. and that is expected to be a big catalyst because real estate, obviously, it's the most important sector, believe it or not, of the economy. Everybody has to own a house. Very important to the underlying growth or sustainability of the economy overall. New home sales, a couple other data points coming out 9 a.m. on Tuesday, but you do have Fed Jerome Powell that comes out Tuesday as well at 11:20 a.m. And depending on what he says will be very, very important. Now, keep in mind, the markets are so far ahead of the Fed. They have priced in the next 3 to 4 Fed meetings being 50 basis point rate hikes. So if the Fed goes more aggressively than that, it's likely already priced in. If the Fed just goes along with what the markets are expecting, it's kind of like, for an analogy here, say you think your girlfriend's going to break up with you, right? And you're thinking this for months and months and months, and then she finally does. Well, you've already come to terms with it. You've already accepted it, right? So it's not a big shocker. It's not like, wow, like I didn't expect to see this coming. Same analogy here with the markets. We're expecting it, so once we actually get it, it could be seen in a weird way as a sigh of relief. So you have Fed Jerome Powell Tuesday, 9 a.m. On Wednesday, you have a lot more MBA mortgage data that is coming out. And then at 7:30 in the morning, you have another big data point, which is durable good orders month over month. And that's very important for the state of the consumer. Some more bond auctions, but then the main catalyst of next week, which is the FOMC minutes. Now, at the Fed meeting, think back to just not too long ago, about 2 weeks ago, we had the Fed meeting. We sold off deep into the Fed meeting, and then the Fed spoke. They didn't say things that should have been seen as a good thing for the markets, right? He took the 50 base point rate hike off the table, which people digested that the next day. Stock market fell 5% after it rallied 3% in about 2 hours during the Fed meeting, right? Just because he took the 50 base point rate hike off the table, but the markets digested that and the next day puked it all up plus some because they didn't like what was said. It wasn't bullish overall. It was very, very negative. Well, what actually happens and what the FOMC minutes are, the 2 days before the Fed meeting, the Fed meets, they decide what to do with policy, and then they talk about what to do going ahead into the future. And that is the transcript that we get that is called the FOMC minutes. So we are going to get more clarity on what the Fed is expecting to do at this upcoming meeting and what they are seeing in as far as in the economy that is pushing them to make these certain decisions. And that comes out 1 p.m. on Wednesday. And I do think this is Central Time, so I do believe it's 2 p.m. Eastern Standard Time, 11 a.m. Pacific Time. So I think this is just set on Central. But that is going to be a big market catalyst. You're going to see the markets really move in one direction or the other. And I think at this point, I don't really think the Fed could give us anything we are not expecting that would be dramatically bad for the markets unless we got like a 1% rate hike. Just give us a full point rate hike and the markets might freak out a little bit more, right? Because it's not expected. But at the same time, the markets might actually find some relief out of that because the Fed would essentially crush inflation by 1% rate hike and then another couple 50 base point rate hikes. I mean, inflation should be gone at that point, right? So I think either way you chop it out, whichever way you want to put it, I think it's probably going to be a bullish catalyst for the markets. Now on Thursday, you have the second most important data point, GDP growth rate quarter over quarter, second quarter estimate for Q1. Now, this is where you could potentially head into a technical recession. We already had first quarter GDP, which was negative. If this next quarter is negative, not going to be good. But what actually happened on the first quarter GDP report was a lot of export issues and a lot of supply issues in certain sectors, like inventory issues that really pushed that GDP number down quite substantially. That's why on the day the Q1 GDP report actually came out, the markets bounced about 2.5% because they were like, hey, this is not as bad if you take into consideration why the report was actually negative. The markets bounced 2.53%, and that was back here April 28th. So we'll see if we get that same kind of bounce, that same market reaction. It would not surprise me considering all of the pricing in and all of the carnage that we have been looking forward to. Now, you also do have initial jobless claims, corporate profits, GDP price index, continuing jobless claims, core PCE prices, and real consumer spending, all that comes out 7:30 in the morning on Thursday. So all of these are going to be very important. And I think the odds of all of them being bad are very, very low. If we could just get one good piece of positive news, the markets will likely rally pretty damn hard from that. My personal opinion. Could be wrong, but I think the problem here is not that everything is just going down the toilet, which some could argue is. I think the reason the NASDAQ is down 30% year to date in 5 months, and even more than that in the last 6 or 7 months since we peaked out in November, is because we have had zero good news. Now, on Friday, you have personal income month over month and personal spending month over month. That will be very important. And you do have Michigan consumer sentiment for May as well. That survey is very important. So you do have a lot of data that comes out this week. And I think to get a bear market bounce, all you need to see is really one piece of good news. given what the markets are pricing in. That's what it comes down to. If the markets were only down, let's say 15% year to date, this would be a different story, right? But when the Nasdaq's down 30% year to date, you're primed to see a market bounce until something breaks, until you see bankruptcies, until you see, China saying they're going to lock down for a very extended period of time, until Russia uses a nuke, until something else happens that really breaks, which like 2008 was Lehman Brothers, Bear Stearns going bankrupt, right? That was really the downside that we seen during 2008, and that lasted, 4 years from peak to eventual next peak to the eventual recovery. Until you see something along those lines actually happen, then I think it's going to be very hard to say push the Nasdaq down 40 or 50% peak to trough. Until you see earnings coming in bad, that potentially could be another big catalyst. But at this point, you're already expecting earnings to be very, very bad. So I do think you're setting up for a quite substantial bear market rally here in the next couple of days, potentially next couple of weeks. If we go ahead and take a look at the S&P 500, I think it's very possible that we do bounce back up to about 420 on the S&P. That would really be my target range for a bear market rally, and that's exactly what we've seen right here from the start of the bear market rally all the way up to the peak. That was a rally of about 11%. If we did do about 11% in a rally from where we currently are, or from where the bottom is, from that would put us to about 420, like I said, on the S&P 500. So that would be about a 10% bounce, and I think that could come very aggressively if we do get some piece of good news. Maybe it's the Fed, maybe it's the GDP report, maybe it's anything else, but just give us something. Just give us something. Now, don't squander this opportunity, though. I think this is a once-in-a-lifetime buying opportunity. Not too often you get a lot of time to buy the dip. Look at Square, look at PayPal, look at SoFi, look at DraftKings, look at potentially Polestar or Lucid or Tesla. You don't get these kind of buying opportunities where stocks like that, quality companies, just go down and down and down and down for 6 months straight, and you have time to buy. Usually it's these quick drops, quick recoveries, because the Fed is your friend. And essentially, whatever capital you have at your hand, at your disposal during those times, that's all you can buy the dip on. Yes, you get pretty much instantaneously gratified and gratification because the markets tend to just bounce right back. But if you can acquire large positions and wait for that eventual Fed U-turn and wait for the markets eventually to start correctly valuing these companies, that's where you can become you could be an average person and turn into, boom, a multimillionaire in the course of 3 to 5 years. So do not squander this opportunity. Basically what I'm trying to say here. It could last a while. Honestly, the longer it lasts, the more bullish you should ultimately be. The more money you are likely to make. Now, the Fear and Greed Index over here on CNN Business, we are in extreme fear, really at the bottom end ranges. The last week, we were at 12. Now we're at 11. So extremely fearful, even after the rally that we've seen on Friday. Market momentum, extremely fearful. Stock price strength, extremely fearful. Stock price breadth, extremely fearful. A very strong correlation right now, whereas if the top 5 or 10 stocks are down, basically everything else is down. Put to call options, extreme fear. Market volatility is neutral. This is the VIX, and we'll talk about that in 1 second as we do go ahead and wrap up this video. But safe haven demand, extreme fear. Junk bond demand, extreme fear. Now, I think the VIX is not breaking out to all-time highs because you essentially have a lot of people in cash. And that's like, for an example, would you buy car insurance if you did not own a car? Probably not. It would probably be a waste of money. So big money, they like to essentially hedge out their positions and really buy insurance on potential losses, aka buying puts, when they have a lot of equities. And I think that's why you're really not seeing the VIX breaking out to new all-time highs, because I don't think there's a lot of people rushing to buy insurance when they're in cash. If you're in cash and you have, let's say, 30 or 40, 50% of your portfolio in cash, what's the point of hedging out your other 50% of equities in your portfolio? Because you're already hedged out by owning cash. That's why the large volatility spikes you have seen in the VIX like the crash of 2020 where the VIX went absolutely crazy. It's because you seen a 30% sell-off pretty much out of nowhere, and there wasn't a lot of portfolios that had a majority of their values in cash, right? Then there was a mad dash to essentially buy insurance on those portfolios. I don't think there's a mad dash to buy insurance on people's portfolios right now because so many people are so heavily in cash, right? Hopefully that makes some sense. If you guys are unfamiliar of what the VIX actually is, it tracks the puts and calls on the S&P 500. So when the VIX goes up, there's more puts placed on the S&P 500. But long story short, if there's so much cash out there, why are you going to buy insurance on an asset you don't need to, right? You're not going to buy car insurance if you don't own a car. You're not going to buy puts if you don't own that many equities. My opinion there. So everything here, extremely fearful. I think you kind of got to disregard the VIX as of right now because of all of the cash in the markets. But when you boil this all together, if we can just get one bit of good news, we're going to go on a bear market rally, and it would not surprise me to see a 10-11% rally from the bottom. So that is pretty much going to be all for this video. If you guys found value out of it, hit the like button, subscribe to the channel, consider sticking around a while. Get yourself free stocks down below in the description of this video with Webull, Moomoo, and Public. If you guys also want to support the channel, there is a link down below in the pinned comment for the Patreon. Obviously, nobody needs to do that, but if you want to support the journey here on this channel, that is how you can do that on a deeper level. Thank you guys for watching. Enjoy your weekends, and I will see you in the next one.